Well, after 3 days worth of gains for the S&P 500, today was a little bit of a tap the brakes type of a day. We did finish lower on the S&P 500 by 0.25%. The Dow Jones did continue to go higher, so that was a strong sign for that recently strong bullish posture. Remember, that's the only index right now that has the strong bullish posture. The others have a weak bullish posture. So that was somewhat promising there. Didn't really hear much new out of the Fed today. We are expecting an interest rate hike in December, but nothing here today. Did have a few companies reporting earnings as well. But for the most part, it was a little bit of a quieter day. What I thought we would do with our trade application example today was sell a put on a dividend raising company that's at a very interesting price level. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's November 8th, 2018. First of all, for those of you that are new, welcome aboard. We're grateful to have you in our audience here tonight. Remember, you can subscribe to our YouTube channel. Additionally, we would encourage you to check out our description area. That'll allow you to sign up for our email distribution list, which entitles you to the stocks that are giving you overbought and oversold cluster signals on the S&P 500. We're also heavy users of Twitter. My handle is @BrandonVanZee, and I would encourage you to follow me there. Also, if you get value out of these videos on a daily basis, we'd encourage you to click like and retweet on these Market Outlook related videos to let us know that you appreciate them and you want them to continue. We also have a presence on Facebook. We have a group there. Check out the web address embedded in the logo in front of you. All right, let's go ahead and dive into the analysis here for the day. As you can see, I've got chart 4B pulled up in front of us here for those of you that are premium Market Scholar subscribers, if you want to follow along with my presentation here tonight. So this particular chart setup is basically going to show you the four major U.S. equity indices out there, and it gives you a sense of how their postures are shaping up side by side by side. So as I mentioned in the intro, of note is the Dow Jones Industrial Average, which is the chart in the upper right here. Notice that we were actually up just barely. We were up 0.04% today. But that continues a strong string of wins here recently. Notice that we could really go back and count to this day. 1, 2, 3, 4, 5, 6, 7, 8. So we had about 7 out of 8 days to the upside at this point. And that was a strong enough move off the bottom where you now have this a little bit darker shaded color of green, as you can see on the chart. And that occurs when this intermediate line crosses above 50, and it gives us the sense that we now have a strongly bullish posture there. The other three charts, including the S&P 500, the NASDAQ, and the Russell 2000, notice we still have that lighter green shading there. It is nice to see that in all three of those charts cases, we are trading just barely above that moving average, so that's a first step there, and hopefully if we can see some resilience here in coming weeks, we should be able to follow suit as far as what we've seen there with the Dow Jones on our recovery from the very nasty month of October, where we saw some precipitous price drops along the way. So all things considered, yes, it's true that most of the indices had a little bit of a pullback here today, but after the furious rally we've seen off of the lows, I think we're probably due for a little bit of a breather. So as long as we continue to trade above the moving averages, we get a sense of bullishness out there, particularly this time of year when the calendar usually suggests that November, December, January are pretty bullish for us as well. So let's go ahead and take a look at another chart. This time, let's take a peek here at chart 4C, and this is our 3 green arrows chart. Some news to report on this front as well compared to where we were on Tuesday when I last did this video. We do have 3 green arrows across the board. Remember, on Tuesday we didn't have any charts that had 3 green arrows on it. So in the last couple of days we have acquired 3 green arrows in all of those cases. And that all occurred because the price closed above the 30-day moving average in all 4 of these charts' cases. Remember, we already had the green arrow on the MACD and the stochastics on all 4 of the charts 2 days ago. So we were kind of just waiting for that moving average to be crossed, and we can finally make that claim here. So Remember, the 3 green arrows strategy is oftentimes used by trend traders. And by the way, I teach my top-down trend trading class every Monday at noon Eastern time. With the exception of this upcoming Monday, I do have some family members in town from out of state. So I will plan to take that day off from my normal class schedule. But normally on Mondays, I teach that class. And our goal in that particular class is to look at the markets at the top level to see where do we stand from a trend trading perspective with all stocks. And then we kind of narrow our focus down into the strongest sectors within the market, the strongest industry groups within there, and then finally select stocks that look very strong within all of those key areas. So if you have an interest in that and you're a Premium Market Scholar subscriber, I would encourage you to check out my Monday classes. And of course, those are always recorded as well. Let's take a peek at another chart here. This time, let's take a peek at our chart 4E. This is our 12 grid analysis here. And we start with the intermarket analysis view. Remember, when you see the pink background in this case, it just means that we have a bearish posture using the intermediate term line on the market forecast. When you see the green background color, it means we have a bullish posture. So as it stands right now, you can see that there are a handful of green and pink charts on the board. Of note, at least from my perspective, is the US dollar here today. The US dollar had a very strong day, so we shouldn't be entirely surprised to see our 3 commodity charts all to the downside today. Notice that gold was down 0.33. Looks like ag commodities down 0.51. And crude oil down 1.59%. Crude oil has just been a true house of pain here. Notice all those oversold cluster signals stacking up day after day after day. So you'd think we'd have some sort of a reversion to the mean eventually. But if we continue to get these strong days like we saw to the dollar today, then it just makes it a much more difficult task. Let me right-click on that US dollar chart, go to maximize sell here, just to make sure you guys can all see it, even if you're watching this on your smartphone. But you'll notice here that the US dollar had this nice little pullback right down to this 30-day moving average here. And a lot of times when we have that 30-day moving average increasing or improving to the upside, oftentimes it can be used as a launch pad for price, and that's exactly what we saw here with UUP. And remember, that has reverberations across financial markets, not only the commodities that I just mentioned a moment ago that are priced in US dollars, but also foreign securities can struggle on a relative basis compared to a lot of US securities if the US dollar is strong. And so you have to keep that in the back of your mind. It can also affect multinational companies that are based in the United States. So anyway, the US dollar is a very important asset. Even if you're not trading it itself, it does have some negative effects occasionally on the stocks that you might be trading. So that was a big day for the dollar. Notice the size of that candle right there. That's a really big range that we saw for this particular product. Remember, currencies typically don't move around a tremendous amount. So this was actually one of the bigger candles that we see on the board here today. So keep your eye on the US dollar. Let's take a peek at another chart. In this case, let's go over here to the foreign stock markets. This is chart 4F. And notice what I mentioned just a moment ago. If you look at these charts here, the vast majority of them were down. And not only were they down, but most of them were down more than the U.S. markets. Remember, the S&P 500 was only down 0.25% today as kind of your bogey there as you're comparing these other indices from around the world. You can see our exception to that was Israel, which was an index that I discussed a little bit more in length on Tuesday as well. It's showing some resiliency up there. But all the other charts show losses here today, and some of them pretty extreme losses. Notice that South Africa was down 4.8% today. So that was a pretty ugly move lower. We saw Germany down 1.9% today. Yikes. Look at Mexico, down 6.7% today. And then we had China down 2.3%. India was down 1.8%. Russia was down 2.2%. And Brazil was down 2.87% as well. And so I'd have to believe a big reason for that pullback, at least to the extent that it hit these foreign markets to a larger degree, was because of that strength in the US dollar right there. So again, commodities weak today, foreign markets weak today, largely because US dollar was strong. Let's take a peek now at our US sectors 12 grid. That's chart 4G. And as we've got this chart pulled up here, you'll notice that it's a little bit more of a pleasant picture here. Notice that all 12 of these charts that we're looking at have green backgrounds, telling us that they all have bullish postures right now. So it's pretty rare to see that, but it just goes to show you how strong the rally has been for the stock market over the last couple of weeks. It's basically carried all the boats up with that rising tide. And so that's where we kind of find ourselves right now. Obviously, as you start breaking down the price patterns of the various charts, some of the charts look a little bit better than others. You know, some of them that I've been pointing out here recently have been the consumer staples remain very strong. It's a good looking chart right there. New 3-month high in the consumer staples here today, as stocks like Coca-Cola and Procter & Gamble and Clorox and Hormel, McCormick, a lot of those companies doing quite well right now. We also see that the utilities remain pretty resilient. Remember a couple days ago, the utilities didn't even have a bullish posture, but I said don't give up on them yet because the price of the security itself suggests that it could easily go back to bullish posture anytime, and of course that's exactly what's happened. Notice that we are still trading near the highs of the 3-month range for utilities, so that's still in that possible breakout zone there to the upside. So don't fall asleep on what normally would be very boring utilities. Sometimes boring is beautiful, and that's where we find ourselves right now. A lot of these defensive areas of the market are the ones that are attracting a little bit more attention. All right, let's take a look now at a couple of other charts. I wanted to look at the ratio charts, and that's chart 4I. As we look at the ratio charts, we try to get a sense of how one asset class or one index is compared to another to try to tell the story of the market. Notice this one right over here. It's kind of our turquoise color off to the left. It's stocks versus commodities. And when we saw this line going lower here in this ratio chart, it basically means that commodities were big time outperformers versus stocks. But notice the quick turnaround here in just the last couple of weeks where stocks have taken the command of that ratio chart, and we're now up here close to 3-month highs all of a sudden. And of course, if the US dollar remains strong, which continues to pressure commodities, we could very well see a breakout to 3-month highs here in the next couple of days on the stocks versus commodities ratio chart. So I did find that one somewhat interesting here. We do see that this kind of trend here with small caps versus mega caps has continued, where in this particular case, when you see the chart going lower, that means that mega cap stocks are outperforming small cap stocks. So again, going back to that mentality I mentioned a moment ago, this is a market that is continually looking for more defensive posturing. And a lot of times you find that the mega cap stocks are perceived to be safer than the small cap stocks out there. And so that's where we continue to be there as well. Notice that U.S. stocks remain resilient versus foreign stocks. So this gray chart right over here shows us a nice surge higher in the last, let's call it, week or so, telling us that U.S. stocks are outperforming foreign stocks. And notice that we're close to 3-month breakout from that perspective as well. And again, that is partially due to the strength in the U.S. dollar. So I found some of those moves right there interesting from a ratio chart perspective as well. All right, let's pop on over here to the internet real briefly. Wanted to mention, as we regularly do, that on our website, so this is marketscholars.com, you can go to the blog to actually watch this video on our website. I know some of you also watch it through your YouTube app on your phone, and that's fine as well. But one of the benefits of watching it here on our website, for those of you that like to leave us feedback, you can actually do your various likes and whatnot directly from this page. Generally speaking, we like to see at least 100 people clicking like on these videos to give us an incentive to continue to do these videos. Remember, we don't make any advertising dollars or anything like that on these videos. We're doing this out of goodwill, and so we want to make sure that our time spent on creating the videos is time well spent. So we do look at those numbers pretty regularly. I do want to thank the 93 of you that clicked like last time around. Again, I'd love to see that number get up and over 100 if at all possible, but we make it nice and easy for you to click right here on our website underneath the video of each blog, and then also your thumbs up there on Facebook, for those of you that associate on that particular social media venue. And then lastly, we have our own little like button on the Market Scholars website. So again, thank you. I know most of you do that on a regular basis, and we really, really do appreciate it. Additionally, I taught a question and answer class today. So for those of you that are premium Market Scholars, I like to kind of review this occasionally because I know not all of you can watch the classes in the middle of the day. So sometimes you're curious what we were talking about in case you want to go back and watch the recording. So here are a sampling of some of the questions I was asked today. Somebody was asking me about Leggett and Platt as a dividend candidate. We talked about Sabine Royalty. We talked about Disney. We talked a little bit about Starbucks and also American Express. We talked about the difference between X dates and pay dates and different things like that. Talked about Kellogg's as a long-term investment. We talked about AMD. We talked about OMI. We talked about PRU. We talked about the philosophy behind why we select a certain delta when we're selling puts. And you can see the rest of them. There's a number of different questions there. This question about the deltas of selling puts will actually kind of tie into our trade application example tonight. Before we get there, let me show you one other link. Remember, one of the other things that I post on our blog every night is this dividend growth investing blog post. And remember, for those of you that click on blog, you can come over here to the categories area on our website. And if you wanted to go to see all the companies that have been raising their dividends recently, just come down here and click on dividend growth investing right there. But you can see that I pulled up the one from November 2nd here currently. And one particular dividend increase did catch my eye there, and it was from AbbVie. And as you can see, AbbVie did increase their dividend by 11%, 11.5%, and their new yield is pretty close to 5%, which is obviously a pretty high yield, an above average yield for sure, in today's low interest rate environment where we find the S&P 500 yielding less than 2%. AbbVie is a little bit of a peculiar case in that it is considered a dividend aristocrat company. Standard & Poor's kind of anointed them a dividend aristocrat because they were spun off several years ago from Abbott Labs, and Abbott Labs had a long history of increasing dividends. So they kind of gave AbbVie a little bit of a free pass there, but it is kind of the ilk of those higher quality names that have kind of a corporate history of dividend increases over time. And of course, AbbVie is actually bigger than Abbott Labs from a market cap perspective. AbbVie happens to be the company that sells Humira, the world's leading pharmaceutical, the best-selling pharmaceutical on the planet. So AbbVie is a company that is a source of controversy because of that Humira, because of course, no matter how great a drug could be, it does eventually have to come off of patent. And so there are a lot of bulls and bears that fight and debate this one until they're blue in the face. And what we've seen here recently out of AbbVie is that they've really pulled back in price during this market swoon that we've seen recently. So for this, I'm going to come over here to chart 3A, which is our dividend stair-step chart that we use in my dividend growth investing class that I teach on Tuesdays. Hang on just a second here. There we go. There's the ticker symbol. ABBV is just the ticker symbol for AbbVie. Now, as you can see here, this stock was really in a nice uptrend about a year or so ago, and then it topped out at about $125. It's since really pulled back significantly in price. You can see we now, as of last week, actually traded below this orange line, and that orange line had typically been used as a support level from an income perspective. That orange line plots where the stock would have to be traded in order to have a 4.5% dividend yield. Well, with the stock raising its dividend, you can see this orange line has actually started to move higher again, all the way off on the right-hand side here. So where it stands right now is we actually have a yield that's close to 5%, and thus this is an interesting candidate as long as you're willing to assume the risk that goes with their concentration on the Humira drug itself. But it does seem to be one that got a little bit overdone to the downside. Remember, in this particular presentation where we refer to the market forecast indicator, these little dots right here underneath these weekly bars, remember this is a 10-year weekly chart we're looking at right now, so every one of these bars represents 1 week in time. Notice that prior to this week, where we've seen AbbVie really go up in price, and that was probably as a result of the news of that dividend increase. But prior to this week, we had 3 straight bars where these little green dots show up. And what that's telling me is that we actually have oversold cluster signals on weekly candle charts. Remember, a lot of times when David and I are talking in these presentations, we're referring to the daily candle when we're using the market forecast indicator. So this is actually a weekly candle, and the cluster signals on weekly candle charts are much more rare than they are on daily candle charts. And so sometimes they can be a little bit more impactful as well. So not only are we at a level that makes some sense from an income perspective, with this thing yielding almost 5% at this point, but we also have had some oversold cluster signals according to the market forecast tool on the weekly candle chart as well. So for this, what I thought we would do is sell a put on AbbVie. And so for that, I'm going to come on over here to the trade tab, pull up ABBV, and I typically look for a return of risk of 1%. And so you can see right here that that would lead us to the $80 put. Now remember, when we're selling puts, that's actually a bullish trade. I know sometimes that can be a little bit confusing for some of you that are newer to options. When you buy puts, that's bearish. When you're selling puts, that's bullish. And that's what we're doing here. We're selling puts. And you can see that we could sell the $80 put and receive about 80 cents for doing that. The bid right now is 77 cents and the ask is 86. So I think we have a good chance to get filled at 80 cents. In fact, the last traded price here earlier today was 82 cents. So 80 cents is definitely in the realm of possibility here to collect that 1% of the strike price. And what we're effectively doing is saying we're willing to buy this stock, but we want to buy it at a cheaper price. We want to buy it at $80 per share as opposed to where it's trading right now at $87 per share. And so we will sell the put on this, and we will receive $80 up front as a credit in our account to be willing to buy 100 shares of this stock at $80. Now remember, you've got to get brokerage approval to do trades like this, so make sure you have that approval. But assuming you do have that approval, that's effectively what you're doing. You're saying, I'm willing to buy AbbVie, but not at $87. I want to buy it at $80. And in return for your willingness, and you're committing to doing that in 43 days, because this is the December contracts, then you will receive the premium as kind of an upfront payment for your willingness to do that. So you would receive $80 right now to be willing to buy the stock at $80 per share in 43 days. So one of two things will happen. Either the stock will indeed go down from 87 to below 80, in which case you would then be obligated to buy the stock at $80 per share, assuming that it stayed below 80 on expiration day. Or the other alternative is that the stock does not go down below 80. Now, if the stock goes sideways and stays exactly at $87 for the next 43 days, or if the stock goes up, or even if the stock goes down, but it just doesn't go all the way down below 80, in all of those cases, you would get to keep that $80 of premium up front. And we've done pretty good with our sold put trades here recently. I just happened to be looking at that on the monitor tab. When the markets pulled back in October, we went to work selling puts because we were not convinced we were heading straight into a bear market. We wanted to be bold when everybody else was bailing out on the market. And so you can see we actually did 3 different sold put trades here in the market outlook presentations, at least when I was doing the video that particular day. We sold a put on Ben, Franklin Resources, we sold a put on Illinois Toolworks, and we sold a put on 3M. Now, all 3 of those companies are dividend aristocrats, just like AbbVie is as well. Remember, there's only 53 dividend aristocrats, so after tonight's trade, we will have done 4 sold put trades on the aristocrat list, and all of those are now making us money. I know it feels uncomfortable many times to be selling puts when markets are selling off, but oftentimes you'll find that can be a profitable way to kind of take advantage of other people's chaos. So for that, let's go ahead and place the trade. I'm going to come over here to the trade tab, click on the bid price. I'm only going to sell 1 contract right here. I am going to bump this up to 80 cents so that way I can get my 1% return on risk. And I am going to change this to a good till cancel order just in case it doesn't get filled first thing tomorrow morning. Confirm and send. There's the $80 that comes into our account for our willingness to buy the stock in December at $80 per share. send that one off and see how we do. All right, well, I want to thank you for joining me here tonight. It's always a pleasure to go to work for you. So, quiet day in the stock market, not a whole lot going on, but it doesn't mean that there aren't opportunities out there. So, keep your eyes peeled, and maybe there's opportunities like we saw tonight with AbbVie and special setups when it comes to dividend orientation as well. So, with that, I want to wish you all the best with your trades and your investments. Goodbye for now.